the webinar, so Understanding the Financial Health of Your Subscription Business, presented by Totango and Zuora. In case you're not familiar with either of the two companies, Zuora builds modern, flexible, and easy-to-use enterprise software that enables companies to manage all aspects of their relationship with their subscribers. We are pleased to have Zuora's Chief Financial Officer, Tyler Sloat, with us today to present from Zuora. Totango is a customer success platform that helps subscription businesses take a data-driven approach to reducing churn, driving adoption, and maximizing lifetime revenue. From Totango, we have Kaiser Mulla-Feroze, Chief Marketing Officer from Totango, to join and present. So without further ado, I'm going to go ahead and hand it over to Tyler. Tyler?
Thank you, and thank you both Christine and Kaiser for doing this with us. And thanks for everyone out there who has joined and taken the time today. We're going to spend this morning's session, both Kaiser and I, really talking about what is happening in the business models today, why this shift is happening, but mainly what are the metrics that you need to be able to run your businesses efficiently and with success in this new business model of subscription. At Zuora here, we've been talking about the shift to subscription now for 8 years since the company's been founded. Back then, even when I started 5.5 years ago, it was more prophetic, and now you can see it across every single industry. And there's a reason for it, right? The reason is that consumers are allowed to be more fickle in the way they consume, and if companies are not providing the capability for the consumer, whether it's a business or just an end user, to be able to consume in a flexible and kind of efficient manner in the way they want to, those consumers will switch, right? That consumption is presenting itself in the form of subscription. That's why Zuora exists. It's why Totango exists, right? We are helping companies run these subscription businesses. There's a problem, though. These businesses are fundamentally different in the way they run. The business models are different, and the metrics by which you need to be able to run your business is different. You're no longer living in a world where you think about selling a product, right? You understand what the bill of materials is of that product, the expense and the COGS of that product. And then you set a revenue, and then you have a delta, which is your gross margin, and you worry then about reselling that product or widget, whatever it is. We now live in a world that we're worried about acquiring customers and how much we're going to spend to acquire those customers, and then thinking about how we're going to keep those customers. And in keeping those customers, we're thinking about pricing and packaging. We're thinking about different services that we can add on. We're thinking about different terminal relationships in time and the amendments of those relationships. This model is very, very complex, right? The old product model was simple. Build a product, sell a product, have some margin, do it again. The new model is wrought with a whole bunch of different touch points with your consumer all the way through the cycle. Those touch points create metrics, right? Metrics that are different that you need to be able to understand. We run our company on ARR. Some companies are run on MRR. Some companies are run on QRR, right? We believe that ARR is the best measure because of what we sell and the way we engage with our customer base. So above everything, ARR is the governor. And the simplest model that you run that business model by is, entering ARR minus churn plus ACV equals exiting ARR. You could add an element of complexity to this right now, where that you would have plus or minus FX impact after the ACV. And we're not going to get deep into that today, but that actually is a huge factor for any multinational organization today, including Zuora. So if you think about ARR as your governor running everything, underneath ARR, you need to be able to understand how to manage your business, all the different elements of that business, to be able to obviously maximize the ARR. We've centered on 3 different metrics that we think are the most important when you actually are focusing on that business model. These metrics are growth efficiency index, your churn rate, and your recurring profit margin. GEI is kind of our take on a CAC ratio or a magic number. The difference is that we don't add in the margin to the GEI because we include that in the recurring profit margin. But it's really about the efficiency by which you are selling. So let's dig in a little bit into these 3 metrics. So first, GEI, growth efficiency index. Everybody is focused on growth, right? Everybody wants to grow as fast as possible. Even a couple years ago, the market was rewarding companies for just the speed of growth as opposed to the efficiency of growth. We've always taken a take that the efficiency of that growth is as important as your capability to actually increase that top line number. That's why we focused on GEI. At the core of it, GEI is really just a measurement on your growth engine and what you're getting for every dollar you put into that engine. We measure it by sales, marketing, and customer success. And the one thing I can encourage anybody out there to do is just keep it simple, right? There's a whole bunch of different nuances by which you could argue that, say, marketing spend, shouldn't be measured against ACV acquired in a period. Depending on your sales cycle, that could be absolutely correct, right? Meaning that the marketing dollars that you spent 2 quarters ago actually might be driving the pipeline that closes today. However you break it down within your organization, be consistent and keep it simple, right? So that you can actually have a metric that you could measure quarter in, quarter out in a consistent fashion. We measure GEI on 2 things, on ACV and on Delta ARR. We include Delta ARR because customer success is part of our growth expense. So think about growth expense as all sales, marketing, and customer success spend, and think about the increment by which you're bringing up your ARR is either Delta ARR or just new ACV, and you probably want to measure both to get an idea of what the raw dollar sales impact is, as well as all of the impact to your Delta ARR. That is GEI. Our next metric that we're going to talk about is churn rate, right? And churn rate is already implicit in your ARR calculation. But it's so fundamental to these businesses in terms of the capability for them to grow efficiently and maintain that growth over time that it is worthy of its being its own number. Now, churn rate is also the main contributor to the most widely disclosed number out there for newly public subscription businesses, and that's net retention. Right? Net retention today, the problem with different companies that are disclosing it every quarter as they go out, whether you're Box or HubSpot or New Relic or Zendesk, they're all disclosing what their net retention numbers are. But since it's like a non-GAAP number, right, they're all allowed to kind of create their own definitions of what net retention means. At the core of it, though, churn is always a part of net retention. And churn is really measured in one fundamental way, which is the raw dollars that leave your ARR base, right? So if you have 10% churn and you had $100 million entering ARR in a period, that means it's $10 million is leaving you. In order to grow, you've got to make up not just that 10, right? But you also have to create a whole bunch of ACV above that. Okay, so churn rate is the connection between the GEI and your business model, right? The reason it's a connection is that if you have a high churn rate, right, you need to be able to acquire very, very efficiently if you're going to be successful, meaning that you need to be able to acquire new ACV at a GEI of, say, less than 1 because your churn rate is high, right? If your churn rate is low, right, you can afford to spend a little bit more so that your GEI can actually go up to be able to acquire that new ACV because the lifetime value of that customer is going to be higher. And so that's how these 2 things connect and play together. One of the best early examples is SuccessFactors versus Salesforce, right? SuccessFactors, when they first came out, they were selling to big enterprise, right, a very sticky product. And as such, they actually could afford to spend a little bit more on their GEI, on growth. And they're at GEI of 1.5 to 2.5 at times, but their churn rate was sub 10% because it was these big enterprise deals, long-term deals they were selling. Workday is very similar in that way. The inverse was Salesforce, right? Salesforce started, and they're different today, but originally they were selling to SMBs. Their churn rate was more in the 20% ratio. As such, in order to have an efficient model, they had to figure out how to acquire at a much cheaper rate, right? And so their GEI was sub 1. It was really like 0.8 back around when they went public. But they had to do that to be able to survive, and that's how these 2 things play against each other. The third metric we're going to talk about is recurring profit margin. I consider this as the CFO of our organization as the cornerstone to our business model. It is our capability to understand how we are going to run a profitable business, right, and actually have fundamental control over our business model. Recurring profit margin is the delta between your entering ARR, so not revenue, that's the difference between a regular product legacy business. It's entering ARR and what you're spending, right, to support that ARR base. We argue that that spend is COGS, G&A, and R&D. So if you sum up your that recurring expense, which is COGS, G&A, and R&D, the delta between that and ARR is your recurring profit margin. Your recurring profit margin, you can choose to spend on growth, right? You can choose to spend more than your recurring profit margin on growth and choose to lose money. Or you could choose to spend less than your recurring profit margin on growth and bring the delta to your bottom line as operating profit, right? This is your capability to control your business model. The larger your recurring profit margin or the smaller your recurring expenses compared to entering ARR, the more control you will have, right? And this is one of the fundamental things that the analyst community is now looking at as they look at these new subscription-based businesses to get a better understanding of those businesses' capability to have free cash flow in the future. You'll actually see a bunch of write-ups now with recurring profit margin being referenced, in some of the analyst write-ups. So the question is, how do I put this together in a business model? If I have these fundamental concepts, right? I have recurring expense, I have growth expense, I have ARR. How do I actually think about it and then come up with, what are the good things to be able to benchmark myself off of against, and what are the bad things? Here's the simplest picture of it, right? You have 100% ARR. Let's say you're running a business at 50% recurring profit margin. It means you're spending 50% or 50 cents on every entering dollar on COGS, G&A, and R&D. Well, you could choose to run break even in sales, marketing, customer success, or you could choose to invest more, right? That choice should be dependent on how efficient that GEI is, right? As well as how much cash you have in the bank, so how much you can afford. But fundamentally, right, if you have a GEI of 1 and churn of 15%, you could actually run a break-even business while still growing 35%. The efficiency is so important that if your GEI was actually, half as efficient, so you have a GEI of 2, that break-even business actually slows down to a 10% growth as opposed to 35. All spending the same amount of money, right, breaking even, just growing a lot slower. So what are your benchmarks then? How do you know what your GEI should be for the size of your company and your recurring profit margin, right, and your growth expense? We break down about 15 different companies. We've been doing it for a long time. We actually run this model internally. We don't do a kind of a traditional operating plan as we enter a year. We actually think about what our recurring expense goals will be, what our recurring profit margin goal, which is the inverse, will be, what our churn rates will be, and then how much we want to spend on growth expense with an assumed GEI. Then we benchmark ourselves against some of these companies to determine whether we are actually in operating in best in class or not. You can see a company like Box has done tremendous strides to become more efficient over time as they've grown, right? And when they went public, they got a lot of flack for how much they were losing, right, and how much money that they were actually spending on growth. But as you can see from their recurring profit margin, they're doing better and better. HubSpot actually has run a very disciplined business. John Kinzer, the CFO there. You can see that their recurring profit margin has remained very, very consistent right around the 50% mark, and he's actually increased it, right, a little bit. Meaning that he goes into every quarter, every year, and everybody is aligned that they get to spend 50 cents on every dollar of new Delta ARR and existing ARR on recurring expense. And that's how they can continue to innovate, but also keep the lights on for their business. They also have a GEI and ARR that's gotten much better, and that just feels it, right? And the more efficient you can become in acquiring, the better, the more money you will have and the more you can spend. NetSuite is a little bit more mature. Obviously, they've been public for a long time. But what is great about their fundamentals is that even though they're getting bigger, right, they're actually becoming more efficient as they grow. And you see it on their GEI and ARR, that number has gone from a 2.3, meaning that they were spending over $2 to acquire every new Delta ARR dollar, that they're now got it down to 1.5. And if they can continue this and get it down to 1, you will see this reflected in the multiple of their stock in market, right? ServiceNow, as well, has just been a darling of Wall Street, and there's a reason, right? Because not just do they have a very high recurring profit margin, right, at almost 60%, but they're extremely efficient in the way they actually acquire dollars, right? You can see that their GEI is well under $1 and has been. Now, it is getting tougher for them to acquire as they grow. They're about an $800 million ARR business, right? And as you get up there and continue to have to put up new growth numbers, right? Salesforce now struggles with this every quarter, quarter in, quarter out, right? You have to go into markets that you maybe were not into anymore, right? And you have to continue to invest in the field. That investment, right, as you get bigger, is tougher and tougher and tougher to keep up the same growth rates. And then there's Zendesk, right? And Zendesk, who is newly public, is very disciplined and very well run. Alan Black has been writing the same thing. But what you can see is they invested heavily in their infrastructure, right, in their COGS, G&A, and R&D. So when they went public, right, they actually had, they were spending, they had very little recurring profit margin, spending almost all of their ARR base in recurring expense. But as they have grown every quarter, they become much more efficient. This is what you will need to do, similar to how we do it, in order to understand, okay, if I say I'm going to center on a couple of metrics, whether they're GEI, churn, and recurring profit, or your own take as an organization, right? How do you then determine whether you are setting yourself up for success or for failure? And the best way to do that right now is to look at the benchmarks, and then look at the companies that are successful out there, that are in similar markets, that might have a similar sell to you, right? And then actually break those companies down, right? It's a little bit of work, but there's a lot of data out there. And then to the extent that you don't have the data because it's not publicly available, you just got to pick up the phone and start calling people, right? And you start calling, you'd be amazed at how open folks are to actually sharing, because we all live in the same world with inadequate, availability of data, imperfect information, but there's a desire for collaboration. So once you end up with those benchmarks, you got to say, okay, how do I then bring this into my company and operationalize it, right? We haven't perfected everything, but we do have a framework that we think it works for us, and we have been able to institutionalize it within the organization. And we call this framework Padre, and then we add PPM to the bottom. And Padre for us is pipeline, acquire, deploy, run, expand. And then the PPM is product, people, money. In that framework, right, we are able to address every element of the customer touch point, and then come up with a set of metrics, below, these three metrics that really govern the entire business model, right? But a whole bunch of metrics that are within each one of these Padre elements. And then, to be able to operationalize it, right, you then need to say, okay, if I'm talking about pipeline, how should I hold the marketing group accountable for pipeline? And how do I know, what we should be able to get for every dollar we spend on an event, right? You then need more benchmarks, right? Those additional benchmarks are even harder to get, but these are actually fundamental to, almost every company out there in just subtle different ways. What we did is we put out a survey. We said, okay, we want to be able to understand what our benchmarks are, and then we want to be able to share those benchmarks out to help companies run their businesses. So we did a CFO summit. We put out a very invasive survey of 100 different CFOs, right? Ended up getting about 150 CFOs to take it at the end of the day, with 100 survey questions, right? With over 10,000 points of data. Just to give you a snippet of what some of those questions were, right? So that we could fundamentally put all the little elements of our business model together, and on a weekly, quarterly, monthly basis, understand whether we are doing a good job. And as we did each one of these little things, it would drive results into our business model, which would confirm, right, our GEI goals. It will confirm our recurring profit margin goals, and our churn goals, which ultimately would help us get to our ARR goals, which runs everything. So I put up two examples here, right, on kind of just fundamental, simple things, but elements of the survey that you could see. So one of them was, okay, when you engage with a customer and you are selling your product in a subscription framework, how are you signing these customers up? Are they month to month? Are they quarterly deals? Are they completely usage based? Or are they termed? And what you're seeing out there is that there is a trend for longer and longer contracts. The customers, specifically if it's enterprise software, right, they want to be able to lock in their vendor and have a visibility to price for future costs. And as a vendor, right, you absolutely want to have a longer-term relationship with your customer and have the security of that committed ARR going forward. So you're seeing now that, most deals out there from an enterprise software SaaS perspective are 1 to 2 years out. Another interesting metric, right? Upsells, right? Which is, something Kaiser's going to talk to in a second here. how do you think about your expansion strategy within your organization, right? And then how do you go execute against that? And understanding that upsells can be, one of the, if not most important, one of the most important elements to your business model. How are you designing your deals today for the future upsell in the future? And, one of the big things was that, obviously, yes, upsells are key to the business models, but how do you execute it? Well, a lot of it's around changing your pricing and packaging, right? And having the capacity to be able to monetize that customer in the future. So what I've just covered, right, is the capability to say, we are living in a different world with different business models. Those models have new metrics, and they're more complex, right? If we pick a couple of those metrics that are fundamental to this business model, understand what the benchmarks are, right? We've picked growth efficiency index, churn, and recurring profit margin. And then we built a business model around it. Then we benchmarked ourselves against, who we would consider to be best in class out there. And then we've been able to operationalize that with a framework called Padre. And then understanding that each element of Padre has a whole functional group, and that they will need to understand how to actually execute within their function, reinforced, right, through a whole new set of data points on what we should be holding ourselves accountable to. And then we continue to iterate on it, and we're just going to keep doing it and keep doing it until, we ultimately keep achieving our goals. That's a very quick summary of what we're talking to. I'd like to hand it over to Kaiser now, who's going to actually address some of the key metrics that Totango follows, that are also near and dear to our hearts on the retention side.
Tyler, that was really interesting. Zuora, I think, has definitely been at the forefront of these discussions on the subscription economy. It's, I think, as I was listening to you talk about the metrics like GEI and recurring profit margin that you guys have coined over the last few years, it's a really interesting sort of twist on some of the traditional financial metrics, but specifically as they relate to the subscription world. And for the second half of the webinar, what I'm going to do is really dive deeper into the customer retention side of a subscription business and discuss specifically the concept of customer retention cost and a new metric which we call the CRC ratio that we have just introduced. But before I jump into that, I just want to take a step back and provide some context. So when we look at a subscription business or any sort of a recurring revenue business, the reality is that 70 to 80% of the revenue that you get from any customer, from any given customer, that comes after the initial sale. 70 to 80% of revenue comes after the initial sale by way of renewals, repeat purchases, upsells, cross-sells. And so I think the big change that all of us need to drive as subscription businesses, operationally, culturally, and definitely financially, is the shift from a focus that most companies have around acquiring new customers to now retaining, nurturing, and growing our existing customer base. And if you look at it, the economics behind this, the economics behind customer retention and growing revenue from within your existing customer base, I think that is ultimately what determines the financial health and well-being of a subscription business. Yet if you look at some of the portfolio of metrics that most subscription companies and even boards and investors look at, I think the concept of customer retention cost is in some ways a critical missing piece. And that was clear to us when we did our last SaaS metric survey as well, which we do annually. And one of the findings there was that compared to customer acquisition cost, which is a very popular and commonly used metric, a much smaller percentage of companies are today tracking and reporting and measuring, and frankly even aware of their overall customer retention cost. So I wanted to just sort of connect this back to Tyler's point around GEI and putting money back into your business. And companies are all the time trying to make these investment decisions. Correct? We talk to a lot of subscription businesses, certainly SaaS companies, but also media companies, telcos, and they're all trying to figure out in some ways how do we go about making these incremental go-to-market investment choices. Specifically, should incremental investment go towards acquiring new customers, or should it go towards retaining existing customers? What is the right level of investment for customer retention? Are we under-investing on the customer retention side versus the customer acquisition side? And how should the relative spend between customer acquisition and customer retention really change over time as your company grows and your company and your business matures? And getting to some of these decisions is really difficult when you don't have the full picture. And so what we've noticed is that today, if you ask any company about their customer acquisition side of this equation, chances are that most companies have a pretty good sense of their customer acquisition cost and their CAC ratio, which is really the amount of money that you need to be spending to bring in every additional dollar of new business. And I think the SaaS industry has also, over the last 10 years, developed some really great benchmarks around customer acquisition cost and the CAC ratio. But when it comes to really looking at the customer retention cost, there is very little visibility and guidance in terms of what companies should do, how should they think about customer retention initiatives as well as investments. And that was really sort of the driver and the motivation for developing this new framework on CRC and what we call the CRC ratio. As you can see here, we've broken it down into 4 easy steps, and I'll walk through each of them in brief. If any of you want to delve into more details as well as sort of get into more of the nuances around calculating these different metrics and ratios, the full report is available to you on SlideShare. So let's start with the first step. The first step, obviously, is getting a better handle on your overall customer retention costs and your overall customer retention efforts in your company. And of course, companies are looking at it. It's not that companies don't look at customer retention and customer retention efforts, but I think today most companies are not really reporting on this as a combined overall metric, even if they may be tracking it in bits and pieces across the organization. And the way we look at it, I think CRC should include all of the expenses a company incurs in retaining and cultivating existing customers. Everything from the cost of your customer success, your account management, your renewal teams, to the customer engagement and adoption systems and tools that you're putting in place, all the way to customer adoption programs. Now, as we were sort of doing our work on this report, there are a couple of nuances here which we get into more detail in the report if people are interested in taking a look at it, and that is around whether professional services and training should be included within customer retention cost, and whether customer marketing, which traditionally is not within customer retention, should also be included within customer retention cost, and we delve into that a bit more in detail within the report. The next step is calculating what we call the CRC ratio. This is the equivalent to the popular CAC ratio, and this actually can be pretty revealing. As we've done work on this and as we've looked at our customers and what this ratio really ends up showing, I think it's really interesting. The CRC ratio fundamentally sort of answers the question, how much are we as a company spending on the dollar to make sure that we retain and renew every dollar of revenue from our existing customer base. And the important thing, as we were debating this with people before sort of finalizing this report, the important thing here is that you should look at your customer retention cost relative to your entire revenue base. The point is that in a subscription business, all of us are ultimately trying to protect all of our revenue, not just the revenue that may be up for renewal in the next month or quarter. And so it's important to look at your customer retention cost relative to the entire revenue base. The next part that we see a lot of companies interested in is really looking at some benchmarks, and comparing their own customer retention efforts against others. The big question we get from companies sort of all the time is how much should we really be spending on customer retention? And in order to develop some of these guidelines, we've broken CRC down into 3 major components: staffing, systems and technology, and lastly, programs, customer retention programs. And today, without a doubt, if you look at most companies, the biggest cost component within customer retention cost is staffing. a common way that a lot of companies sort of think about their investment in customer success staffing is around revenue per customer success manager, or revenue per CSM. And when we sort of looked at this closely, we think that this figure is significantly influenced by a few considerations, such as the sophistication of your product, the maturity of the space in which you're operating, and frankly, just also the size of your company and the stage of growth that you're at. And we combined these different factors into a single factor we call complexity. And based on the complexity of your business, we've developed some guidelines which are outlined in more detail in the report around staffing for customer success organizations. And it ranges all the way from one customer success manager for every $1 million in ARR to every $4 million in ARR. And when you look at this from a percentage of revenue standpoint, it works out to approximately 10 to 30% of revenue. That is what we see a lot of companies doing today. The second component of CRC is systems and technology. Now, over here, I think before we sort of go into it, I think it's really important to understand the nature and purpose of these solutions that we're talking about. And we think customer success systems and technology fall broadly into two categories. The first one is productivity tools for your teams, and the second is around customer monitoring systems. The first one is really a tool to help your CSMs manage their portfolios, their customer portfolios, manage their day-to-day jobs. In some ways, it's the equivalent of Salesforce for your CSM team. And companies typically spend about 1% of their staff costs on this. If you want to translate that to a percentage of revenue, taking the staffing metric from the previous slide, it works out to effectively 0.1 to 0.3% of revenue. The second piece of systems and technology is what we call customer monitoring systems. These are systems that are actually monitoring consumption, monitoring adoption, monitoring the service delivery of your applications. They're event-based applications, unlike a typical CRM-type system. And we like to think of it in some ways as a Fitbit for all your customers and a Fitbit for all your users. This is an essential component for a digital company in really driving customer retention and understanding customer engagement and ultimately getting to that retention and getting to that revenue that you expect from your existing customer base. And so we think that the best metric and the way to think about your expenditure on customer monitoring systems is more as a percentage of revenue. And based on our experience working in this area with a number of subscription companies, not just SaaS, but also other subscription companies, the general rule of thumb is that companies should be spending at least 0.5 to 1% of their revenue on customer monitoring and customer consumption monitoring systems. Now, the third component of CRC is customer retention programs. This, according to us, is a very critical part to scaling customer retention and customer success efforts within your companies. It includes everything from development of best practices to product adoption campaigns that you may run, to new feature training and webinars that you may hold, to just building an overall customer community. And as a rule of thumb, we recommend that companies spend at least 1 to 2% of revenue on this. And often we see that this goes hand in hand with systems and technology that companies are putting in place, specifically around consumption monitoring tools. Because this now allows companies to programmatically impact customer retention and customer success programs based on an understanding of not just each customer, but also of each user and what they need, what does each user need, and how can you best as a company drive more user engagement. So we're seeing that best-in-class companies are making bigger investments in this area along with their investments in consumption monitoring tools as a way to scale their customer success teams and their customer retention efforts. Now the last part, going back to the framework, is really around looking at both customer acquisition cost and customer retention costs together, relative to one another as well as combined. And I think this helps subscription companies, get a good overall view of the entire business. So on this slide, you see sort of the comparison between customer acquisition cost and customer retention cost. And I think this can really help make some of those go-to-market investment decisions that we were talking about earlier, about sort of those incremental decisions about where should you really invest your dollars. So for example, let's say you have 50% of your revenue coming from existing customers, that you're spending 5x on CAC compared to CRC. I think that can really help you calibrate your business better. Even though we all know that acquiring new customers will always cost more, sometimes 3 to 6 times more than retaining one, doing this comparison between CAC and CRC can really help you understand whether you're under-investing on the customer retention side. Basically, what most companies want to know is that where are we going to get the bigger bang for our buck for this incremental investment? And that is where a comparison between the two really, I think, can be very useful and can be very revealing. At the same time, we also recommend to our customers that they should be looking at both CAC and CRC combined. So let's say it takes X dollars to bring in $1 of annual revenue, and then it costs you an additional Y dollars every year to retain and renew this $1 of business. That gives you sort of a combined view and gives you a good sense of what it takes to both acquire and retain a new customer, and then figure out the financial health of your business based on your ability to monetize customers beyond both the combination of CAC and CRC. And this is where I really like the slide that Tyler presented earlier in this deck, which really sort of shows the overall P&L view. And today, if we look at where companies stand, today if you look at the numbers that I presented on customer retention and add those up and put them along with the standard benchmarks that we see at least for SaaS companies around the CAC ratio of 1 to 1.5, today I think most companies are definitely operating in this zone. Companies are making a significant investment in growth, and as a result, I think most SaaS companies see a significant operating loss in their P&Ls. And if you look, one of the things that we did as part of the study was also look at some of the public SaaS companies, and it's clear that today, even public SaaS companies are not making an operating profit. And the report, if you want to get into more details, the customer retention cost report will detail more of the calculations and metrics for these 5 public companies. The financial picture overall, again, is not surprising because I think as an industry as a whole, we're all very much right now investing in growth, and we're all investing in optimizing for top-line expansion. Now, that said, I do think that over time, as the industry matures, at least as the SaaS industry matures, we've already seen that in other subscription businesses, but at least for SaaS companies, as the industry matures, ultimately, I think companies will have to aim for a P&L that looks something more like this. And this obviously means that both customer acquisition cost as well as customer retention cost will have to come down over time. And specifically, talking about the customer retention side of things, I think companies will start needing to make more investments on the programmatic sides that I spoke about earlier. Invest more in customer retention programs, invest more in the systems and technology to make these numbers work and to get to a P&L that looks more like this once the industry matures. So that's all I have for today, and I'm going to turn it back to Christine now to take some Q&A for Tyler and myself. Thank you.
Thanks, Kaiser, and thanks, Tyler. I'd like to go ahead and encourage all of our participants to go ahead and submit any of their questions in the bottom left chat window. And as Kaiser and Tyler review the questions, we'll go ahead and pull a couple up right now. I think one question that is great for both speakers is someone wanted to know whether or not they've seen buy-in or resistance to any of these metrics from the company's executives or board members. So when we talk about GEI, churn, recurring profit margins, and as Kaiser, as you talked about the CRC, do you guys see buy-in or any resistance from boards? Tyler, do you want to take that one first?
Yeah, I can start. we first introduced the subscription business model, we call it, about 4.5 years ago. And we brought it into the board and said we're not going to do a traditional operating plan. We're going to run this subscription business model with these set of metrics. That meeting did not go well. And in fact, I think I almost got fired. It's okay to look back now, but at the time it was stressful. And the reason was it was our fault, right? Because we hadn't done enough work, both in pre-selling, but also in understanding the benchmarks, right? Because we came in introducing new concepts without being able to demonstrate why these concepts actually made sense and what other companies who had been successful and other companies who had failed, what those benchmarks were. So we did a lot of work, right, on starting to do the benchmarks. We then pre-sold it with the board and came back in. The next step was really making sure that the execs were aligned on it, because it doesn't do any good if we could set an operating plan based on these metrics like recurring profit margin, GEI, and churn and things, without having the understanding that the executive staff was aligned and they were fully bought in. Once we got them fully bought in, the most interesting thing happened where we had the guys who were in charge of, say, growth expense, right, who were being funded to go grow, right? They own sales, marketing, customer success. And then the folks who were in charge of your recurring expense, which is your COGS, G&A, and R&D. And then being able to facilitate the debate that if we sacrifice some recurring expense, right, we were run ourselves lean, and we could spend a little bit more on growth expense. The capability of what that growth expense would mean in terms of increased ARR might actually result, instead of one more head, one more engineer today, 3 more engineers 3 quarters from now, because of the way ARR would grow, and then the way that our recurring profit margin goals would work. Once we were able to sell that internally and get everybody aligned on it, right, we were able to demonstrate that to the execs. And then it created a very healthy tension within the company, because we were all very in line on what these metrics are. But we also had a situation where we were funding certain areas on the growth of ARR, on the promise of growth of ARR, which then would result in funding for the other areas, right? So everybody was supportive of that fund, and everybody was aligned on making sure we were successful. And then once it happened, which it did, we all got to invest more. That was fundamental, both in the education, to the board, then the education of the executive staff of why this made sense, right? And then the discipline of running it quarter in, quarter out, and staying true to those benchmarks.
Sure, I can add to that. So obviously today we are operating in a very different world than what Tyler was mentioning 4.5 years ago. And I think thanks to a lot of the education that Zuora has done about subscription businesses, I think people today do get it. So as we sort of launch this thinking around and introduce these new metrics around customer retention cost and the CRC ratio, I don't necessarily see any resistance. I actually feel like there is a lot of hunger within boardrooms and within executive suites to be able to better assess their customer success and customer retention efforts. That said, I think very often the reality of day-to-day business does take over, and I think we are still a relatively young industry. And as a whole, I think there still remains, a great deal more focus around the customer acquisition side of the equation. And I think companies are gradually sort of realizing that, they really do need to look at CRC and their retention efforts separately. And we increasingly see that even from an organizational standpoint, the customer success team or the VP of customer success or the chief customer officer now really does share the table with the SVP of sales and the CMO. And we see that happening more and more in organizations. So I think the buy-in is definitely coming.
Great. Thank you both. Kaiser, a couple questions came up about your formula for calculating the retention cost. One about marketing and another about customer support. So how do you go about breaking apart marketing expenses into CAC and into CRC? And then how does customer support get factored in? Do you want to take that?
Sure. So let me try to cover those in brief, and obviously there's more detail and explanation in the report. So let me take the customer support one first. So I think for SaaS companies, the established practice today is to put the cost of support under COGS, or also what people call cost of revenue. And so if you look at the financials of public SaaS companies, the same thing applies there. The cost of customer support shows up under COGS. And as a result of that, when we did our analysis, we left cost of support under COGS. So to avoid sort of the double counting and adding it both in COGS and CRC. Now, in our discussions, some people did debate, whether cost of support should actually be under CRC versus COGS. And I personally think that, the widely accepted practice is appropriate, partly because you can view the cost of support as a necessary part of keeping your product or service up and running, just as hosting or data center costs that also go into COGS. And so I think that, continuing to consider customer support costs under COGS is an acceptable approach, and that's what we did. About the second question around marketing, specifically customer marketing. So again, for our study, we decided to keep marketing outside CRC. Now, you could debate that a certain portion of marketing, more around customer marketing, should be part of CRC, and there are ways to sort of break that down. Specifically, the things that you do more programmatically, the campaigns, the customer adoption campaigns, the customer engagement campaigns that you run, and if they happen to be run through your marketing department as against your customer success department, they could definitely be considered to be part of CRC. But just for simplicity and also to avoid a lot of confusion when it comes to comparing with public company numbers, we decided to leave marketing as a whole out of CRC.
Great, thank you. Another question came in that maybe both Tyler and Kaiser can answer around the metrics for early stage B2B companies. They don't have a lot of history in the form of churn, cross-sell. How would you, or what are your recommendations for those early stage? Tyler, do you want to take that one first?
Yeah, I think it's, I saw the question come in, I think it's from Vishnu. It's hard when you're early stage, right? Because you're just starting, and a lot of the metrics don't hold from you from a business model perspective in terms of you don't have the scale yet. What you do need to make sure you understand is, where do I need to be, right, at a certain point of scale. So what we've done is we've broken down all these companies, as I've mentioned, and we've taken as far back as possible so that we can look at even a company like ServiceNow, who is, $800 million ARR business, but we can look at what they were like when they were a couple $100 million of ARR to understand what they, how they got there, and then how the inflection point of change happened within that organization. And you can look at this across a whole bunch of different organizations and normalize. Now, if you're just starting, right? If you're just starting as a business and you're worried about the next deal and the next deal, then it's different, right? Then you're really operating under a cash constrained model, but really worried about, okay, the deal I closed today, how do I make sure that that's going to generate a successful customer for me that I'm going to be able to monetize in the future, and then I could turn and use as a reference for my next successful customer, right? And that is a completely different model around metrics and whatnot, as opposed to a holistic business model, right? The business model is more relevant once you get to a little bit of scale.
Yeah, and I'll add to that as well, Vishnu. So we definitely, when we looked at these numbers, we definitely looked at early stage companies and companies that are starting out. And some of the metrics that you see, especially around staffing, had a pretty broad range to them, partly to account for the fact that, when you're an early stage company, you're often investing ahead of revenue. And so you are probably on the upper bound of those ranges. And we've seen companies, even in the very early stage, once they have, a handful of customers, the revenue may depend on what your average deal size is, but, even when companies have 10, 20 customers, they begin to make some investments in customer retention. It could be potentially hiring their first customer success manager. It may not be a director or VP level person, but they begin doing that by hiring a CSM, and they begin putting in place some customer success programs. In the early stages, it may be done in partnership with the marketing organization that may actually execute some of these customer engagement and adoption programs. And increasingly, as companies grow, they may carve them out within the customer success team.
Great, thanks. I think we have time maybe just for one more question. So Tyler, you talked about some data that came back from your CFO survey about the percentage of revenue that comes from upsells. And this question might be pertaining to more of the Padre operationalizing approach, but who have you guys found typically manages the upsell component, and how should people go about engaging with the customer? And maybe you can also hand that off to Kaiser to both answer that question.
Sure, absolutely. So the upsell component starts with the way you price and package, right? And that how you're building a relationship with a customer that's going to allow you to actually be able to monetize them to a high degree in the future. And I think that monetization typically happens in three different ways, right? You either have different modules or something that somebody's going to buy from you. You have some other usage model that as the customer grows, you get to grow with them, right? Per seat models are the most traditional in the SaaS world. Or third, you're going to do a land and expand and get to different divisions within that organization. The Padre framework really is capability to have people who are responsible for functions or living within a certain function understand the upstream and downstream ramifications of what they do and how it relates to a customer, right? And so in the E, which is expand, right, within the Padre, right, who really owns the expansion revenue? Today, I think there's a natural transition, right? Well, whether your customer success, you are seeing companies hire that position a lot earlier on. I've seen it often, present itself out of customer support, where all of a sudden you have a couple of customer support people, and then you close a big customer and they need special attention, so you ask your best rep to spend extra time with them, and all of a sudden you have a couple big customers, and all that rep is doing is spending time with two customers, and all of a sudden they look much more like a customer success person trying to promote adoption and everything else, as opposed to a customer support person, and then the group evolves from there. The next evolution is really, does customer success turn into sales, right? Or do you create a hunter-farmer relationship within your field organization where you have people thinking about new logos, and then you also have other people who are thinking about how to increase the monetization of the existing logos, whether it's through renewal or upsell, or the reduction of churn, right, which is just as dangerous or has the same impact as an upsell, right? And so for us, we have a customer success group, right? They work hand in hand with our sales organization. They get handed a customer from professional services as the implementation is going. They are responsible for churn. They're also the indicators of upsell, meaning that they're tracking and looking at adoption. We have very key delineations of a healthy customer versus one that we would want to get healthier, and then the propensity for any customer to churn based on the way that they're using our product. But also the customer who is ripe for upsell based on the way they're using our product and their trend of usage compared to their contract. And then our customer success group works with sales, who our sales reps today are still comped on any incremental ARR value that a customer gives us, meaning that if they get an upsell, right, which is an increment to ARR, so it's increased ACV, they will get quota retirement on that. And we might evolve as we go forward to get to more of a hunter-farmer, but we're right now, because of the relationship with our customers and because we want our salespeople to stay engaged, we think that's the right thing to do. Kaiser, I want to know what your thoughts are there too.
Yeah, sure. So at Totango, we have a very similar approach. We use the same model that Tyler described, and I think we see that happening in a lot of SaaS companies. Definitely sort of, maybe I think in the public SaaS companies it tends to be different, but I think we use a similar approach. And but I do think that even though the upsell and the sales team does get compensated for upsells, I do think that the customer success team or the account management team or whatever the label may be within your organization, they do need to, in some shape or form, own upsells and own that retention number. Because we've worked with hundreds of SaaS companies at this point, and we do notice one thing, that when when the customer success team has a clear revenue responsibility and accountability, those teams definitely are more successful. They have a better profile within the company, and there is a greater likelihood that the executive team and the boards will actually invest in those teams. So I do think that it is important for customer success teams to have a very, very close connection with the retention and the upsell number. And different companies are today doing it slightly differently. It may be that the sales team continues to get compensated for upsell, but the customer success team is a critical piece of that.
Great, thank you both. I want to thank everyone today for joining our webinar. I know we full hour and appreciate your time. As you see displayed on your screen, there are ways to get in touch with both Kaiser and Tyler, as well as learn more about both companies posted on the screen. Thank you for your time. At this time, we'll go ahead and close the webinar. Thank you both Kaiser and Tyler for joining us today.
Thanks for doing this, Christine.
Thank you.